Morning, Market Chameleons. Happy Thursday morning. There's my man, Dimitri Pargamonik. How you doing, Dima?
Hey, Will, how's it going?
Great. Let's jump right into the disclaimer.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. What's going
I
on
think
today,
what we'll
buddy?
do today is we'll take a look at the pre-market report, and then we'll discuss, the importance of data. And I think that we had a question yesterday, and it was a good question because I think that question is very common from beginner traders. So I kind of wanted to address it and maybe explain it a little bit further. Okay, so it's like where I think maybe beginners are making mistakes, and the mistakes are really, I think, in the mentality of risk. What is risk? What are risk market stocks, options? And I kind of wanted to maybe just make a few points about that. I'm not going to keep it that long today because I have a kind of a little bit of a cold. So unless we have questions, I'll go to the end. If not, I just prepared like something short.
All right, great. And that question was brought up on the chat yesterday by, and I think it was DA. He was new, and he was asking, why is data that's already happened important? Can't we see data before it happens? Type of thing.
So the question was, well, if we're looking at data and information, right, statistics, this is looking in the past, right? So we're looking in the rear view. What we want to see is, well, tell me what's going to happen before it happens, right? What's going to happen tomorrow? What's going to happen, a month from now? And I think that's a common question because I've heard it before, and I was doing a little bit of reading about it, research, because it was an odd question to me. So I just kind of wanted to prepare it just to address it, because it's not an embarrassing question. I'll tell you, 95% of the people ask that question, right? Especially when they start out. That's a very common question. So that's why I wanted to kind of address it and explain it a little bit better, because I think this will give people some insights.
Now, do you want to put the live link out so if people want to ask questions live, they can come into the Zoom?
Yeah, definitely. So if you guys have questions about this, you could put it in the chat, or if you want to ask your question live, we're going to put out a link there. You could raise your hand. We'll put you on speaker, right? You don't have to put your video on there, but we could put you on speaker, and you could just ask the question directly. Sometimes it's easier just to ask it than to type it in.
Yeah, perfect.
Okay. So let's do that. I'm going to first take a look at the pre-market report, and then we'll get into the discussion. So these are stocks that are actively trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here really quickly to the list, and I see 44 made the percentage gainers list, 85 on the percentage decliners list. So from that perspective, a little bit more of a bearish bias at the open. This list, they're not that big, but slightly more bearish, 2-to-1. Let's see if we see the same picture in the higher market cap stocks. So I'm going to use this filter, market cap 20 billion or higher. And here we see 8 on the percentage gainers list, 23 on the percentage decliners list. So they're slightly more bearish at the open. But again, this list, it's not very big, so if big would be considered, a couple hundred on the list. So if there are no questions on the pre-market, I'll kind of just get into the discussion of that question.
All right, perfect.
So do you have the exact, and I'm not picking on the question itself. I think it's a good question. That's why I want to talk about it, because I do hear it a lot of times. Okay, that's why I just wanted to.
Yeah, I don't have the exact question. I know the mayor's on. Maybe he remembers it exactly. I think it was a two-part question. First is, why is it? I mean, we're seeing data that's already happened.
Right.
How is that even useful? because it's already happened. And the second part of it is like, I want to see what's going to happen before it happens. Those
Right.
were
So
like,
we were looking at data, like we were looking at what was going on yesterday with the options volume. We took a look at the open interest, and then I think that question came up. Well, why are we looking at that data? It's already happened. It's in the rear view, right? So here's the question. So I wrote it right. So I wrote that down, and before I get into that, the data part, there are a few things I want to say that there. When I talk, when I hear things, even coming through emails or some questions, I think that even though people think they understand stocks and options and risk, and everybody thinks that, right? I don't think that it's very clear to people, what risk is and what's going on when they first get into it. And I'll tell you why I think that. Because I will have questions like, I'll have things people that tell me like, look, I understand this is risky. I understand that there's risk involved, but my goal is to make 20% per month. And I just don't want to lose money, right? That's my goal. I just don't want to lose money, and I want to make 20% per month. Well, right there off the bat, you don't understand risk. Risk is not, you just don't want to lose money. Risk is that there's uncertainty and you're actually risking losing money, right? That's what a stock and option is. There's no such thing as, well, I'm not going to lose my principal. I'm just going to either make 20% or 5%. That's not how it is. Risk is that whatever you invest, you could end up having less at the end. That's risk. Okay. And part of it is, I think that if you look through our educational system, first grade to 12th grade, right, there's zero education on investment. We never get, there's no class investment. We learn history, you learn math, you learn English, all that stuff makes you well-rounded. Zero on investment. If you go to college, unless you're major or minor in it, like I did, there's really barely any education on investment. And honestly, I don't even think the teachers really understand it either. So there's this misconception coming in. And Alan Greenspan, who's the Federal Reserve, had all these PhDs, and they did this study, right? And they did a study. Well, why do these beginners lose so much money, amateurs, and why are there other people on Wall Street that make so much money, right? So he likes to look at data, and sometimes he just sums it up very simply. He has a way with words. I'll show you how he said it. So here's how this is Alan Greenspan quote: "Amateurs want to be right, professionals want to make money." Okay. And they did and this is the conclusion he came with, and they studied, massive amounts of data. He didn't study this himself. He has a bunch of PhDs working for him, and this is the conclusion. So what does that mean, right? Like, what does it mean? Amateurs want to be right, professionals want to make money, because obviously everybody wants to make money, but that's not how that's not what the data shows. That's not what their interviews show. And let me give you an example. Okay. So I took a really simple game, right? Very simple game of risk. And it's a coin flip. And you have heads and tails, right? So you flip it. And if it comes out, if you pick heads, it comes out heads, you win. If it comes out tails, you lose, right? What would an amateur looking at this game, what is their first thought? How do I win this game? Like, what would people say? I have to anticipate, or I have to be right which side comes out, right? So what I have to do is, before it flips, I have to determine that it's either going to be heads or tails, and I have to be right. Okay, does anybody disagree with that? How would other people, if you're not, and don't be embarrassed, because this is how everybody starts out, baby steps. How would a professional look at this game? Does anybody, let me know if anybody looks at it differently.
Well, I know at one time the mayor, and this was in a previous conversation on the chat, he says heads has a better opportunity of coming up because it's a little heavier on the head side.
Okay.
I don't know if that's true.
Okay, but let's just assume that's not, that it's a fair point, right? So if it's a
Hey,
fair
AD,
point, yeah.
you've gone underwater. You may want to step back.
Can you hear me a little bit better?
No, it sounds like you're garbled.
Do you want me to exit and come back in?
Yeah, why don't you exit and come back in?
All right, so you guys think about this, like how would a professional look at this game? What would be the questions you would ask yourself before you played the game? Now, an amateur, like I said, they're gonna look at it and say, I gotta predict if it's gonna be heads or tails. I'm gonna close out of this as a group. Okay.
All right. As Dee said, give your comments about how you look at this game. So when he comes back, we have some comments. Mike saying 50-50. Albert expected value. Mike Moreau, we love the show. Thank you, guys. Listen, we do try to put the link to the Zoom in the chat. If there are any questions, we'd love for you to come on the Zoom. I think would be more interested in seeing how the questions develop, because questions lead to more questions. So I'm going to put that link back in. Also, in the coming week, we have a bunch of different webinars coming up. Our Ginsu Nice salesman, Dan Passarelli, probably people on the chat have seen this before, may not want to attend, but new people may. Dan Passarelli is going to be on Sunday evening with me. On Monday, we have the doctor coming back at 10 a.m. to review his trades and maybe look at some more trades. That's Jake, who runs the Discord, which has a lot of chameleons on it. If anyone wants a link to the Discord, I will put my email in the chat. So that is Monday at 10 a.m. And then Tuesday, we have Raj, another big active chameleon who's big in the Discord group. So Raj will be on Tuesday. That's Raj with webinar with Raj. So we got a lot of interesting stuff coming up, which is always good. We've 9 thumbs up with 50 people watching. Thumbs up are always nice. Gene is always nice. Mike H always talk about giving us thumbs up. I don't say that probably enough. It does, as Mike, the mayor, has said, it does help the YouTube algorithm. He's probably figured that out. I have not, but he has mentioned that before. So thumbs up would be great in the algorithm. Still waiting on Dima. Let me just check the Zoom. Yep, we are live and we are waiting for Dima to come back. Mike, I don't know what's going on with those microphones you recommended, by the way. He's been going underwater a lot. Mike says, I love Dan, and Dan tends to be very salesy. Yes. I think Goat coined the phrase that he's a Ginsu salesman.
Hey,
AD, you're back.
all right. So unfortunately, when I rebooted, I lost all that. But let me just bring up my.
I don't think you have to reboot. I think all you have to do is log out and just go click on the link again.
Okay. Well, let's just. I'm gonna bring it up. Like I'm gonna just bring up heads. Tails. Let me just see that.
All right. Well, the chameleons did answer when you were out.
Okay.
There was Michael said 50-50. Juan says 50 each.
Okay. So these are right.
Statistics and probabilities, what Andy said. Albert says expected value.
So those are good answers. And I'll tell you, most of our customers, I think, are more sophisticated and they know how to use data, right? Or they would just not be around at this point. But those are good answers. So when you look at heads or tails, an amateur would just be like, I need to pick up what the next one will be, and I'm going to bet, and I think tails is going to be the next one, so I'm going to bet on it, just like a stock or an option, right? And that's not how a professional trader would look at it. Like I said, they're looking at, well, one, they'll start asking questions like, what are the rules, right? So you need to know what are the rules to the game, right? So they'll study that. I don't think a lot of people actually understand that, like our market structure and stuff, but they'll, but you want to understand what the rules are, where, how are options treated, how are dividends treated, all this type of stuff. You have to understand it so you don't fall into a trap. The other things is, yes, like what are my odds, right? So here we're looking at 50-50, right? But the other things, what are my probabilities, right? What is my risk, right? Those are based on the odds. And what is my potential reward? What is we could say expected return, expected return. I think I heard somebody say that, right? So what does that mean? Why would I, make this bet? So for example, let's say, I bet on tails, right? And if I win, let's say I win $1. If I lose $1. Well, that's an even game. There's no real edge there, right? In the long term, I'm expected to break even. But if somebody says, hey, you know what? I really want tails. If you switch to heads and heads comes out, I pay you $2. If tails comes out, you pay me $1. Now you have a positive expected return, right? Because for every time you lose $1. Every time you win, you make $2. So in the long term, you've got a positive expected return. And that's what traders are looking for, is an edge, a positive expected return that you could define, okay? And that's the difference between an amateur who's just trying to pick and be right, and the professional who's he's not necessarily looking to be right, he's looking for an edge, positive expected return, all right? And that's what I think Alan Greenspan meant by amateurs want to be right, and professionals, they just want to make money. They're looking for something that they think is a profitable trade, not necessarily right, because they could still be wrong, but a good trade, right? So if I bet on heads and it comes out, I make $2. If it comes out tails, I lose $1. I still have risk. I could still lose $1. I have no idea what the outcome will be until the game is played. But before the game is played, if I think that the odds are 50-50 and those are my payoffs, it's a good bet, right? So it's not about knowing what will happen. It's about making a good risk reward bet. Does that make sense to people?
Yeah.
So remember when people say, well, tell me what's going to happen tomorrow. I don't know. Just like I don't know, before you flip this coin, I have no idea if the next thing will be heads or tails. But I know this, if you're willing to give me more money if heads comes out, then I have to give you, if tails comes out, then it's a good bet. All right. So that's just a quick example of an edge. So obviously I gave you like a simple example because heads, a coin flip, it's the most simplest thing. Everybody knows the odds of that. There's only two outcomes. There's no other possible outcomes. Stocks and options are different. That's why we use financial modeling, because we need to create estimates, because there's no such thing as just heads or tails. Stocks could end up, they could go up or down, but they could go, there's many different outcomes going up or many different outcomes coming down. So that's some of what I wanted to address, that we're looking for an edge, right? We're not looking for being right, what's going to come out tomorrow. And then some people say, well, why do we use, past data? Why do we use past data? Because it doesn't tell us what's going to come out tomorrow. All data is some kind of a record of something that happened, right? So to have a data point, something had to happen and we've recorded it. So by nature, data is historical. You cannot, if we could call up the New York Stock Exchange and be like, hey, can you send me a list of all the closing prices for tomorrow? And, just to make it easier for me, can you just filter that out for stocks that are going to be up 200% or more And they'll be like, oh, sure, Mr. Smith, I didn't know that you were looking for that. I thought you were just trying to make it hard on yourself. It doesn't exist, right? New York Stock Exchange doesn't know it. NASDAQ doesn't know it. I don't know it because it hasn't been played out yet. Whatever happens tomorrow, we won't know until tomorrow. So that's why data is always historical. Something, it's a record. Something happened and we record it and then we study it. So just wanted to mention a couple things like that. So why do we look at historical data? And when we look at historical data, hold on, let me close all this. So when we look at historical data, if you don't know your history, you're going to repeat mistakes that history has taught us, right? History teaches you lessons, and you want to learn those lessons so you don't repeat the same mistakes. Everybody know that. And for example, when people say, well, why do it happened, it's on the books, why do we look at it? You guys know, the super Tom Brady, right? Tom Brady is, how old is he? Like in his 40s, won all these.
I think 41 or 42.
Right. He just won the last Super Bowl, right? So this is a quarterback who, sports is a little bit different. As you get older, right, you kind of lose your edge because it's a physical sport. But he's won all these Super Bowls. Where's his edge? And he doesn't, it's not only, in his physical ability, but he actually sits there and studies past games of his opponents to anticipate what they will do. So he has a game plan before it even goes live. So real-time data, think of it as you're live, you're playing, and if you're not prepared, you're gonna get eaten up by sharks. As soon as you turn on those live data, you better know what you're doing. And your game plan better be good, because if you're trying to figure it out in real time, you're gonna get eaten by the sharks. And that happens to everybody, right? You're not going to figure it out in real time. It's like, imagine a lawyer not preparing for any case, not looking at, well, who's this judge? How does he rule before? What is my evidence? Once you step in real time, you better have a good game plan. And if you don't, you're going to get destroyed. And that's the other thing. People try to turn on real time, think they're going to figure it out the answer is going to come to them by the flashing numbers in front of there. Doesn't happen that way. Take a look at Tom Brady. He doesn't figure it out real time. He studies it ahead of time. A boxer, he's going to look at videos of past performance of his opponents to be able to plan ahead of time. So when he steps into that ring, he knows already, he has a game plan, and he already knows what he's going to be doing, right? Have you guys ever heard of Alexander the Great? So Alexander the Great was a young guy. He defeated an army of like 4 times his army, right? So if you looked at any numbers, anybody who's, and I think we have like military people are actually like very good at using data, right? They understand it. And if you go to the military, nobody's going to tell you, hey, jump in there real time and figure out what to do in a war. They're going to study history, even history, not even like the history of your current opponents, but history of long battles that were fought way before. And one of the ways he was able to defeat an army, I think it was like 3 or 4 times greater than this Persian army, was that he took the data, the historical data, and he looked at how they won their battles, what they wanted to do. I think like they had their secret weapon was these chariots that had these big knives sticking out that chop people up. So ahead of time, he figured out how to neutralize that and trap these horses. He did some other things, positioned his people, but defeated an army 4 times greater. I don't think he ever lost a battle, but he was like the Tom Brady, right? You took the data and the lessons and prepared yourself, but that was using historical data, not something in real time. He didn't know the outcome of the battle. He just had the game plan ready. Did you guys ever hear of Big Short? I'm just giving you some examples here. So Big Short, I think it was a movie, right? By a book by Michael Lewis. Um, and it was about a guy, Michael Burry, I think his name was, hedge fund
That is
guy.
correct. Yeah.
So what did he do? He made a huge bet that the subprime mortgage was going to come down. And what he did was he looked at the data and figured it out from the data, from the recordings, what was going on and what was most likely going to happen, right? He saw that, hey, there are people taking out these mortgages like never before. They were taking out variable rates that were going to get readjusted at some point. These people could not afford it based on this. People holding this risk are going to, there's going to be a lot of defaults. But this was all done because he was able to look at the data and anticipate what would be happening going forward. Didn't know for sure. And by the way, he was actually wrong on the timing. He thought it was going to happen much earlier, and he was sitting on big losses for a while. But because
I think he even had to change the structure of his fund to hold people's money in there because people wanted out.
Yeah. But his conviction remained the same because he had the information data on his side. He almost lost. He almost had to cover. I think he was very close to having to cover it. But the data, was on his side. He had conviction, stayed in. Eventually, it paid off. And this is why we look at information and study. Like another example I'll show you. A lot of people will say, I have to see real-time data. I have to piggyback on these big trades. And I talk to customers who do really well, like some of our customers, they've been customers for years, and I talk to them, and I could tell you this, they never piggyback in real time, but they make notes of what's happening. Like I was talking to a customer yesterday on the phone. He was telling me about trades from 3 months ago that he's still watching, didn't piggyback, but he's saying that, you watched this big trade come in. I think it was like an Uber couple months ago. The guy still has conviction. It was a couple $1 million trade. It was unusual. So, but the point I'm making is he's studying this data and watching and learning. And if you're not willing to do that, you won't be successful. You're not going to be successful. Your game plan is to turn on a machine, look at a moving quote, and figure out right then and there what to do. Right? It's like kind of like trying to go to war in real time with no plan or no preparation, and you're going to get eaten up. So just wanted to kind of make the point of why we use the data, why we use that information, why it's important. And some of the things that, people say like, well, can you tell me what's going to happen before it happens? That's not how it works. We don't know, but what we use it for is to get an edge. Do we have a certain edge in doing something, right? Do we have a certain edge in doing a certain options trade or stop trade or strategy? That's kind of what we're looking for because we're dealing with uncertainty. We're dealing with something that didn't happen yet. Also, risk. When people say, well, I understand risk, my goal is to make 20%, but I just don't want to lose money. You got to understand that risk is not that, then you're not taking a risk, right? Then you should just put your money in a treasury, right? But risk is uncertainty. You can lose capital. The whole point of it is to manage it where your profits on average exceed your losses. Okay, that's why you have to manage and diversify it. So there's no such thing as, hey, oh, here's a great, Apple call. I'm going to put 100% or 90% of my money in there and see what happens. Then it's a big speculation. So hopefully that addresses some of the questions from yesterday.
No, that's great. I know that the next question is, well, how do we use the data? But that's what we do every day, right? Those are the shows we show every day.
Every day. That's why every day we show you different examples, because you could only learn from example. There's no one answer, right? There's no one way to say, here, this is what you do, and every day you do the same exact thing here and here and here. You're learning from history, so you're prepared, right, to know where there's an opportunity, so there's no one right answer, right? Everybody would be doing it if there's just one right answer. It would have been figured out already, right? But there isn't. It's just like there's no one right game plan for to play a football game, right? Because you don't know, things are dynamic, things are changing, players are changing, everything is changing, it's dynamic. But using history, we start to learn from past lessons, not to repeat mistakes, right? And to spot where there are opportunities. And there's experience and education, there's a cost. Like, for example, even for us, we've been training a long time, but even as market makers, it took lots of tries, lots of losing money before you get it right. You start, your initial tries, you're going to be getting wrong because you have to learn, and there's a cost to learning, right? And that's what you do. When you learn, you try things, and there's a cost to it. But the important thing is that you take away a lesson. How do I improve it? What did I learn from it? What do I, what I shouldn't repeat, and what did I learn, that going forward into the future.
Great show, Dima. Everyone's very appreciative. Thanks for joining us, Chameleons. Great job, buddy.
All right. Thanks, everyone. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Trading peace.